The key thing for the moment is that we no longer have that level of fear in people's heads that interest rates are just going to go up and up and up on a continual basis. The worst case scenario is sort of there right now for the people contemplating making a fresh purchase in the housing market. Well, hello again, everybody. Welcome to another monthly Tea with Tony, which doesn't actually involve any cups of tea, brought to you by NZHL. Well, I'm going to have a look at some of the main events which have come along to affect the housing market, economy, maybe interest rates over the past 4 weeks or so, starting with the budget, but then moving on pretty quickly to the main event, which of course was the Reserve Bank's review of monetary policy recently. I hope to get in some comments about the outlook for the economy. Are we still on the road towards a recession? I'm pleased to say my view on that is that it's still pretty much a 50-50 call. And then obviously a bit of a reminder of my outlook for the housing market and some of the things I've been hammering, I guess, quite a bit in the likes of these videos and a lot of my written commentary over the past few months. So let's have a look then at the budget, which happened 2 or 3 weeks ago. Election year, you always have to expect, especially under a Labor government, that there's going to be some easing of fiscal policy. In other words, some extra spending. Definitely, unless things are appallingly bad, you wouldn't expect in an election year a government to actually cut back on spending, fiscal austerity. And the numbers from Treasury show that there's what we call a fiscal impulse, extra boost to activity in the New Zealand economy of about 1.7% coming up in the upcoming 12 months or so. So, there was a loosening in there, and by definition that essentially is inflationary for the economy. But we also saw some offset there with a few of the initiatives the government had in there, such as the public transport age half fare, free fare changes which were introduced, the removal of the $5 prescription charge, and also the extension of free early childcare education down to 2-year-olds if the staff are actually available, and of course that is a big if in this day and age. The budget really wasn't ever going to be looking at transforming the economy in any way. The government previously had made big changes to benefits, so they certainly didn't signal that it was going to be anything too radical, and frankly it wasn't. But I guess the more interesting thing is that a few days after the budget, we got the Reserve Bank with their roughly 3-monthly review of monetary policy and a new set of economic forecasts. And the interesting thing there is that the Reserve Bank did meet market expectations by increasing the official cash rate 0.25%. Pretty much that's what most of us were expecting. But we didn't expect, and I certainly did not expect, that their comments would be so dovish, so along the lines of the outlook for inflation is not too bad and we probably won't have to increase interest rates again. That essentially was the main message I guess they wanted to get across, and it's certainly the main message which was picked up in the financial markets and by the media. And the Reserve Bank reinforced it in a number of ways, noting that the economy shrank 0.6% in the December quarter, whereas they had expected growth of 0.7%. They didn't have to mention that, but they seemed to make the special effort to note that the economy had already shown some reaction to tightening monetary policy since the middle or the second half of 2021. They noted that the 2 most recent annual inflation numbers have come in slightly lower than they were expecting, that some of the wage indicators out there were also starting to move back a little bit, and global supply chains were improving. And of significance, they also noted that for the first time at the vote in the Monetary Policy Committee there, the 7 members in attendance, 2 of them actually voted for no increase in the official cash rate at all. You take it all together, and the Reserve Bank basically has put their stake in the ground and said they do not expect to raise the official cash rate any further than the 5.5% level they have now taken it to. Now, that doesn't mean you can 100% rule out any further increases, because there is a history of central banks getting their inflation forecast wrong. So, don't rule that out completely. But I think it's a fairly low probability, given some of the indicators we can see out there, such as falling away of inflation expectations in one of those measures, for instance. Now, Overall, will this really change the outlook for the economy to any great degree? Because after all, when the Reserve Bank on November 23 last year reacted to the higher than expected 7.2% inflation number we learnt about on October 18, they increased the official cash rate by a record 0.75%. And they also said, look, the economy probably going to go into recession. And they predicted about 1.1% or so shrinkage in the New Zealand economy. Now they still see a recession in the middle of this year, but only about 0.3%. Frankly, that is neither here nor there. In the budget, Treasury predicted not going to have a recession this year. I look at that and I see that as the largest forecasting groups in New Zealand coming into line with the view I've been expressing since the end of November last year, that it really is a 50-50 call as to whether the New Zealand economy has a recession or not. Now, there is actually a chance we might have already had it. After shrinking 0.6% in the December quarter, we might have shrunk a little bit again in the March quarter, and so you might be able to look back and go, oh my goodness, wasn't it terrible? We were in recession. Well, not really so terrible when you consider that job numbers in New Zealand grew 0.5% in the December quarter and another 0.8% in the March quarter. This is a key difference for this period of economic challenge in the New Zealand economy. That's the phraseology I've been using rather than recession. This unique condition of a tight labour market. Businesses know that if they lay off staff and they need them again relatively quickly, they will probably not find them again. The people will either have shot off to Australia, WA, to work in the mines or something like that, or have fairly quickly picked up jobs elsewhere in New Zealand, given that the demand out there is still exceptionally strong. Now, this becomes relevant when we look at, I guess, some of the things which are happening in the housing market, and that's what I want to start turning towards now. What is the most recent news we have with regard to the strength of the housing market in New Zealand? Well, if we look at the data from REINZ, we can see that the number of dwellings sold by real estate agents all around the country, after you adjust for seasonal factors, the usual ups and downs that can happen in each month during the year, we find that sales improved by about 11%. Seasonally adjusted in April. So that's quite interesting. We'll also see that, again, when you make seasonal adjustments, the average level of prices in New Zealand was essentially flat, minus 0.1%, 0% over the 2-month period of March and April. So you can look at that and maybe feel a good degree of confidence that we are at the bottom of the house price and house sales cycle. Now, given the huge uncertainty, the incorrect forecast we have seen for a number of years, it would personally not surprise me at all if we saw prices fall just a little bit further. But we are, I think, well and truly into the bottoming out period for the housing market in New Zealand. And this time, I think we can have greater certainty about that than was the case last year when during the September quarter, the 3 months to September, I was saying, I think we're in the end game. I think we still got falling prices and falling sales, but they're doing so at an easing rate, and we're heading towards maybe a bottoming out of the housing cycle around about the end of 2022. Well, of course, that view was completely blown out of the water by that rogue inflation number released in the middle of October, and people got really scared, pulled back from house buying anew, confidence to spend, etc. took a bit of a hit as well. But things this time around do look a bit different. And I can see some of that coming through in my various monthly surveys. I run monthly surveys of people in their capacity as consumers, as business people, the mortgage brokers, the real estate agents as well, and residential property investors. And what I do with that information is I look for commonalities between the surveys. In a small country like New Zealand, you never want to have a look at just one statistic and say, aha, that is definitely happening, that is definitely where we are heading. There's a lot of standard statistical error in the surveys of most things in New Zealand, so you want to average these things across a number of surveys, and doing that for my housing focus surveys, I can fairly clearly see that we are into that bottoming out period. For instance, it's back in February that both the real estate agent survey I do with REINZ and another survey I do of mortgage advisors there showed that first home buyers are back in the market. And in fact, I'm just tidying up my most recent monthly survey of real estate agents. And this time around, what we've got is about a net 54% or so of the agents saying they are seeing more first home buyers in the market. For the previous 3 months or so, that was around about 22%, and it was minus 3% in January. The average is 6%. We can unequivocally say that first home buyers are reasonably firmly re-engaging with the housing market in New Zealand. And in my videos over the past 3 or so months and in a lot of my written material, I've had a look at reasons why I think the first home buyers are back in there. And it's a number of things, such as rents have continued to increase over a period when on average house prices around New Zealand have fallen about 17.5% from their peaks. In Auckland, it's about 23% or so. Wellington, 24%. That equation of renting versus purchasing has been shifting out there. The stock of listings has increased quite a bit as well. The latest number shows the stack of listings at 25,300. That's well up from under 14,000 in the middle of 2021. Also, banks have been making credit a little bit more readily available recently, I think especially to the first home buyers. So these people have started stepping forward into the market. Now, it manifests itself also in attendance at open homes. My most recent reading from the real estate agent survey again is a net 30% of the agents are seeing more people showing up at open homes. Now, that is well away from, the January number there was about minus, it was a small negative anyway. The average is minus 8%. So yeah, more people are now going around and looking at other people's stuff. Not the investors, however. All the readings I have show the investors are still stood well back from the market, not necessarily running away as rapidly as was the case after the tax changes at the end of March of 2021, but they are increasingly concerned. Again, I can tell from one of my surveys out there, they're increasingly concerned about their loss of interest expense deductibility, and that is starting to motivate a few more, especially with interest rates being cyclically high, to think about maybe offloading their property. Again, zero evidence of a wave of investors looking to sell. So where is it likely that the housing market is going to go from here? Well, I think the starting point there needs to be going right back to the Reserve Bank's monetary policy statement and the review of the official cash rate. What is the outlook for interest rates? Because I think it's fair to say that provided we're not dipping into a whole big new deep recession, when interest rates decline, they will cause an extra increase in the residential real estate market around New Zealand. Now, the Reserve Bank have predicted that the cash rate will sit at the current 5.5% right through to maybe September or so of 2024. And then from there, it will fall away relatively slowly, and in the middle of 2026, so 3 years from now, it will be about 3.25%, so just over 2% down from where we are at the moment. Now, the reality is going to be something different. That's the only certainty you can take here. The forecast will not be right. The question is, and this is what we economists are looking at all the time, is it likely that interest rates don't fall that rapidly, or do they fall more rapidly? The view most of us have is that actually interest rates will probably start going down earlier in 2024 than right towards the end, as the Reserve Bank have put in there. For the moment, that's not really the key thing to be focusing on. The key thing for the moment is that we no longer have that level of fear in people's heads that interest rates are just going to go up and up and up on a continual basis. The worst case scenario is sort of there right now for the people contemplating making a fresh purchase in the housing market. So that to me is a significant thing. It's sort of undoing quite substantially all the scare and the bejeebers, scary words the Reserve Bank used on November 23 last year when they spoke about recession, etc. So for interest rates, frankly, I have a suspicion that for the rest of this year, I might not have too much of interest to say. The Reserve Bank seemed quite determined not to increase them again, but I'd be very surprised if they start making signals any time in the next few months of, maybe we could cut them in January, February, March of 2024. The remainder of this year could be relatively boring. If I were borrowing at the moment, I would still be looking in the 1 to 2 year area. Apparently 18 months is quite popular with a lot of people out there. So now, again, where do I see the housing market as likely to go? I think it's fair to say that I have been hammering a bit of a message over the past few months with regard to some very strong, significant factors coming along likely to not only cause the bottoming out but in the market, but cause prices, etc., to go back up again. I do not fall into the camp of those thinking, we're in a new equilibrium, prices will be flat for 3 years or something like that. No. And so you'll have heard this before, you'll have read it before in my written commentary, but I'm going to run through my little list of reasons why I think time is ticking away for the first home buyers in particular. Number one, there's a migration boom underway. In the year to March, we had a net migration gain, a population boost to New Zealand of 65,400. That's the highest ever if we exclude the weird 92,000 in the year to March 2020. It was the pandemic effect that was simply running through there. Job security is high. If you get laid off, you're probably going to get another job again relatively quickly. That helps underpin willingness to purchase a property. Rents are continuing to rise, and part of the rental stock is now going to service foreign tourists and also the foreign students. So things are tightening up out there. I think, like I say, the interest rates have peaked. I'm not yet putting into this list there, and people expect interest rates to go down. It's just too soon for that. We have from June 1 the easing of loan to valuation ratio rules, and also the recent easing up on the Credit Contracts and Consumer Finance Act rules, and also banks competing against each other for business, not by discounting interest rates but by making credit a bit more available. House construction falling away. This one's going to become a matter of moment, I think, through 2024-25. Most people still aren't aware of the fact that there is quite a substantial decline in house building about to occur in New Zealand. And then two final things. I made mention of the number of listings, 25,300 compared with less than 14,000 in the middle of 2021. So you're sitting there thinking, there's so much to choose from. Well, just be careful on that. You see, listings are already falling. They are down 13% from the peak in December. And history shows when real estate sales pick up, yes, you get a few more vendors coming forward, but you get more buyers and the stock of listings goes down. And the absence of listings, I think, was a key factor explaining some unusual strength in the market in the second half of 2021. And then finally, key point I've been hammering also, there's a 2-year queue. Backlog of buyers. People who didn't buy in 2021 because there was nothing to choose from and the prices were ridiculous. People who didn't buy in 2022 because they were worried about prices going down. And that's where I'm just going to finish off with the other, I think, significant result from my survey with REI and Z of real estate agents. I asked the agents, what are buyers most concerned about? And 3 things have occupied people's minds now for quite some time. One is the level of interest rates, and there's only a small easing of concern there. The other one is access to finance, and again, just a small easing of concerns are there. The third one is FOOP, F-O-O-P, fear of overpaying, worries that I will buy and then prices will fall. Well, that is still relatively high there at about 49% of agents saying that, but that was 68% in April. It's falling away. People still have concerns prices will fall, but their degree of concern is now ebbing away. Like I say, I think the market's in that bottoming out phase, and I do expect to see some strength returning before the end of this year, and the availability of listings starting to fall away. There's just too many things coming together to move the demand and supply curves. And if you don't know what I mean there, just have a review of a first-year economics course, and once you start factoring in things like accelerating population growth versus falling supply, new supply of new buildings, it has some fairly obvious price impacts a bit further out, but maybe not so much in the short term. So look, thanks everybody for paying attention there to this video, and let me just give my usual reminder, these are my own views and not necessarily those of NZHL, and nothing was intended to be personalised advice to yourself out there, but feel free to send me an email if you do want to ask me any particular question, tony@tonyalexander.nz, and if you don't already get my free weeklies Tony's View, you can sign up at tonyalexander.nz. All the best out there.